Good evening. This is the digital age. I'm Jim Zirin. Our subject tonight is the global financial crisis and what is to be done about it. And our guest tonight is Peter Solomon, who is the former deputy mayor of the city of New York for economic affairs. He was the vice chairman of Lehman Brothers many years ago before the fall, and he's an investment banker. Peter, welcome. And before we get to you, I want to play a brief clip about an exchange between Steve Schwarzman of Blackstone and Bruce Wasserstein of Lazard about how the internet might help stem the tide of the financial crisis.
You are going to need a new financial global architecture, and you're going to need a place where regulators can get together and exchange information on what's going on in each country, so you can get a realistic concept of global risk. And right now there is no place that really does that. I mean, if you imagined, sort of a World Bank in session, or some group where that you have permanent representatives from each country, and every quarter they're looking at the risk in their system, the regulatory approach. They publish this on the internet, so you can see globally which countries are creating high-risk systems, where the bubbles are, and by letting everyone in the world know that pretty much instantaneously, one of the advantages of the internet, that capital can then be denied certain of those countries. There's a risk premium, and that can force people to do it. There are other ideas.
A very platonic idea. I don't think people could recognize risk if they saw it. In other words, I think
that's utterly untrue.
Now, Peter, I guess Schwarzman made a number of proposals. One is for a single global regulator, and the other is to use the internet in an attempt to lessen global risk. Do you see anything in that at all?
No. I think that the internet's not necessary to measure global risk. I think there's enough public information available for the central banks to know where risk is, and I think if you read, if one uses the internet intelligently, you don't need to create a new system. I think the data is there. I think it's available. I agree more with Bruce that people understand risk. They make different judgments on risk. The issue is not that people don't understand risk. The issue is different people make different judgments on risk. For example, in Blackstone's case, they make judgments that they can buy companies at 9, 10, or 11 times EBITDA. You might not make that same judgment, so giving them more information won't affect how they risk. Now, there is certain things that are very true. You can have exchanges, which one should have, to take the opaque quality to create more transparency. For example, there's no reason to have default swaps be so opaque. That market, you could have an exchange. That's easily done, could have been done. And the reason it's not done, in my judgment, has not to do with regulators, but has to do with the investment banks and commercial banks who trade these things and don't want efficient, regulated, and transparent markets.
Well, there was a proposal back in the 90s by the chairman of the CFTC, Brooksley Bourne, who wanted to regulate derivatives, and the Treasury Department, notably Larry Summers, who was said to be in the running for Secretary of the Treasury in the Obama administration, said no, we can't regulate derivatives. And do you think that the government dropped the ball at that point?
The government clearly dropped the ball. I mean, I wrote a piece 4 or 5 years ago, it was published, that said what's going on with regulation when you not only had the growth of derivatives, but when you had the elimination of the Glass-Steagall Act.
Better tell us what the Glass-Steagall Act is.
The Glass-Steagall Act was put in the 1930s to separate commercial banking from the securities industry because of the worries that something might occur, such as has just occurred. And it was eliminated under the Clinton administration by Rubin, Summers, et cetera. It had great support by everybody because of the convergence of the securities markets and commercial banks, and the securities firms wanted to get into lending, and the banks wanted to get in the securities firm.
What about Schwarzman's suggestion that it would be more efficient to have one global regulator assessing risk on a global basis?
I don't understand the assessment of risk part. I do think there's a very strong case to have a single form of regulation covering the various types of markets. I think that does make sense. I don't think.
You mean within the United States?
Yes, within the United States.
But what about globally?
Well, I don't think that does make sense. I mean, I think if you get the type of coordination, coordination is the issue. For example, there was not coordination between the central banks of Europe and the United States until the last couple of months. Europe was pursuing one policy, the United States was pursuing another policy. There's no question you want if you're going to have the industrial eight meet, they shouldn't only be meeting on fiscal monetary policies, they should be meeting on regulatory policies. So I do think there's a reason for that, but I don't think we're ever going to get to the point where you're going to have one regulator, you know, so the Supreme Court of regulation. I think that's a ridiculous proposal.
Well, Wasserstein said he doubted the efficacy of global institutions and kind of pooh-poohed the whole idea. And he said the problem was not that we didn't have enough regulation. The problem was that we had misregulation.
I don't know if that's true or not. You know, the problem we have, I guess, one of the problems, which we've discussed for years, is you have to have the punishment fit the crime. You have to have liability. From the Mikado. Exactly. In the Mikado you can learn a lot, particularly if it's done by Groucho Marx. In that case, you'll really not only learn a lot, but you'll get a great performance and the nonsense you deserve. But what you need to really have is you cannot have people taking risks that don't have liability. I have argued for many years that the stem cause of problems on Wall Street comes from limited liability and unlimited capital. And when you match those two things, you will always have a disaster. So that's the issue to me. How do you get people who are taking risks to have the liability? Now, what's happened, regrettably, is almost all the shareholders in the world have learned that they have unlimited liability. And so they may have had unlimited capital, but they now have found that they had unlimited liability. But interesting, the institutions don't.
Now, are you critical of bank regulation in recent years?
I don't know enough about the specificity of bank regulation. What I know is that the bank regulation seems to be much better than the securities regulation.
So the SEC would really drop the ball?
I think the SEC has acknowledged that it really dropped the ball. I think this was
part of it the abolition of the net capital rule for brokers, so the brokers then became, instead of brokers, they became hedge funds.
Hedge funds. And you could see this was going to happen. Look, I think the Kool-Aid was globalization of the securities markets was going to create the next century, the wealth of the next century. And as Greenspan has said and has acknowledged, he was selling the Kool-Aid. And everybody who was in the act, whether they were in the Clinton administration or the Reagan administration, they believed it. Interestingly, of course, all the unregulation started under Jimmy Carter. In the end of the Carter administration.
Now, the chairman of the CFTC, the Commodities Future Trading Commission, has called for really a trifecta, three kinds of regulators, a regulator of systemic risk, and then a separate entity, a regulator of market integrity, and third, someone to regulate and look after investor protection. Do you agree with that kind of approach?
Well, here's what I found the most difficult thing. Of course, commodities trading should have been blended in with everything else. Why isn't it? Because it reports to a different committee of Congress. I believe it reports to the Agricultural Committee. Other things report to the Banking Committee. One of the problems is oversight.
Really didn't have anything to do with the price of beans, did they?
No, that's right. And The interesting issue is congressional oversight, that nobody spent any time. What committees do these report to? One of the reasons that the regulation is fragmented, which I have not seen discussed or anywhere, is they report to different committees in Congress. And those committee chairmen don't want to give up the power.
And they don't coordinate with one another.
Of course not.
So maybe they ought to be on the internet coordinating.
Yes, they should be talking to each other. They actually are in the same house.
Yes. Now, we've seen how horrific these problems are. Obama called it the greatest economic challenge of our lifetime. Greenspan called it a credit tsunami, and unlike anything we've seen in the last century. What do you see as the way out of this?
I don't know the way out of it. I think that those of us who were in positions of some authority in the 70s have some taste of what could happen. The first oil shock, which of course was 1973, didn't work out until 1982. And every stock I was around thinking about sold for single digits in 1973, 74, and we're there today. The credit issue is more dire now. But we had a taste of it then. We even had a little taste of it in 1966, which is really ancient history. This is a credit. I wrote a piece recently called "It's Credit Stupid." This is a credit issue. It's not an earnings issue. This is a credit issue. And we have to free up the credit markets. And I think they're beginning to free up.
Well, they're beginning to free up, but you take TARP, the Troubled Assets Recovery Program, introduced by the Bush administration to be administered by Secretary Paulson, and there's, what, $900 billion there for trouble. First it was for mortgages, now it's for almost anything. It keeps shifting. But under TARP, and a number of banks have applied for capital infusions with the Treasury taking some kind of equity interest in the bank. There's no requirement that they lend the money.
No, and that's ridiculous. There are so many things wrong with TARP that a number of congressmen and senators voted against it, including some people I'm close to. And I couldn't tell them they were wrong to vote against it because it was such a bad program. I did tell them they were wrong because I knew we needed something. But the substance of the initial proposal by the Secretary of the Treasury was someplace between inadequate and idiotic. And
inadequate and idiotic?
Yes. And he has rescinded. He has, I took that position early, and he has confirmed that position yesterday when he said it was the wrong program and he's going to change it. Your point is exactly right. There has to be a requirement that they lend. They have to have a requirement. If we give you this $25 billion, we want you to lend 9 times that, or 10 times, or 8 times that. If that happens, then we'll get going. Now, there's a very curious thing going on with TARP. They're forcing some banks to take the money that don't want it.
Yes.
Now, the question is why? And they put the banks in an extraordinarily difficult position. Because if you're a bank board, you take the money and you get Henry Waxman, an oversight committee. If you don't take the money, you can be criticized if something later happens. Curious.
Well, so the key is to get the banks lending again.
Yes.
And in England, where probably the central bank is regulating 6 banks, they made it a condition of the investment that they lend
Absolutely.
on a leveraged basis of about 10 to 1.
Absolutely.
Here, there's no such condition, no talk of such a condition, although the Fed is supposedly prodding the banks to lend the money they receive from the Treasury. But it's hard to see how, without a requirement that they lend, that TARP is going to get us anywhere.
Absolutely, but it can get us somewhere. One of the problems, of course, we're in a lame duck area. Who cares what Paulson says, in fact? What does it matter? He's out of a job, and he's got his protege running the program, and who cares about him either? So, and who cares about the president? So the problem is we're in this interregnum. But the Obama administration has got to make that a condition, and I don't see it yet because we don't have a Secretary of the Treasury. But that Secretary of the Treasury has really got to run the program.
Well, a number of names have been mentioned, and do you think they're all qualified to run the program? Volcker, Summers, Gaithner, Most recently, there's been speculation about Jamie Dimon, the chairman of J.P. Morgan.
I think they're all very qualified. They're all distinguished Americans. They're all distinguished in terms of their careers and their integrity and all that. I think it's a really sort of, I have a little different take, I think. I think the monetary and fiscal issues are pretty clear at this point. I think what you need is somebody in whom people can have confidence, and I think you can, well, it's just a question of what 4 or 5 media people say about the person, and you can influence that, number one, and each of those people would be good in that regard. But I think you need a deal-making person. I think this is a time for deals. You know, Henry Morgenthau was FDR's Secretary of the Treasury. Besides being his neighbor, which helped, he was from a distinguished banking family, and he knew how to do deals, and he knew how to get things done.
Well, not really. He was a farmer in Dutchess County. Well, he had a newsletter, something like your newsletters. It was called the Agriculturist.
Yes, well, that was his nom de agriculture. But he was from a pretty distinguished family, which has incidentally continued, of course, in Bob Morgenthau.
Well, no argument there. There's also been great criticism of TARP because of the huge bonuses that continue to be paid out by our banking institutions or by AIG, the extravagant seminars in Florida. I mean, should the Treasury condition investment on curbing the bonuses and curbing the perks and curbing the extravagance?
Well, the answer is, of course they should.
Why not? Why
Even
aren't they doing it?
Of course they should, because it's public relations. Because you cannot ask people. The TAR program was inadequately explained. It became a Wall Street bailout instead of being an economic or crisis, a credit crisis, you know, a bailout. And it became sort of it had the wrong nomenclature off the first tee. Having said that, of course you have to have, as part of the political process, a whole discussion on compensation. It's obviously a sideshow. It obviously has no substantive matter, but it's a political issue. Of course it has importance.
Should the TARP money be used to bail out Ford and Chrysler and GM?
Yes.
You think it should?
Yes, I don't see any difference between bailing out Goldman Sachs or bailing out Ford Motor Company. The Ford Motor Company probably has more, creates more wealth, has the potential than Goldman Sachs.
More labor intensive.
It's more labor intensive, employs more people. I think the answer is yes. I was in the Carter administration when we did Chrysler. There was a lot of hemming and hawing about it. The government actually made money on the Chrysler deal. As you know, we took warrants. We took an override. We made money. It was debated. My problem in this regard is it took us months to negotiate the Chrysler deal. And we're talking about throwing money at General Motors in a vastly more complicated environment. Well, who's going to make the deal? Who's the deal guy? Where's the beef?
Do you have a deal guy in mind who could do it?
Ah, there were deal guys around. You interviewed 2 of them before, Wasserstein and Schwarzman.
Well, I didn't interview them. Fortune interview.
Oh, Fortune interview. There are deal guys around, but this is going to be an important part. And one of the criticisms, incidentally, of the Paulson administration is that he put in charge, and I made this criticism, which I'll repeat, and he put in charge a 35-year-old fellow who's obviously very talented.
Kashkari.
But who has people who, as you know, called cash and carry. Cash and carry.
Goldman Sachs guy.
Yeah, cash and carry. But he put in a fellow who didn't have any deal experience. And it's not the fact of where he came from, but the fact he had no deal experience. And deal experience in this case is important.
Well, of course, the problem with the automobile industry is they fail to curtail their costs so that they can really have a viable profit, and pouring money into them is not going to solve that problem.
Yeah, well, we don't know how it will solve the problem, frankly. You know, I do a lot of work in the theater world, as you know, and somebody once said, a union fellow said to us when we were saying how hard it was, he said, well, just give the people what they want.
Yes.
I said, if we knew it, we'd do it. And this is the problem here. You know, clearly, there are clearly problems in giving people what they want. And
well, here there are a number of problems that center on what people want. I guess one of them is home foreclosures, which are up 25%. Another is jobs. Applications for unemployment benefits are at a 7-year high. All of these are problems that have to be addressed by the new president and his administration.
Well, there's a very interesting thing on home and we can look at history, and we look to when I was in the Carter administration, the end of the Carter administration, there was 21% unemployment in Flint and Pontiac. Does it sound familiar?
Yes.
All right. There's 20% unemployment in Toledo and Akron. We put a lot of money in there. I proposed at the time that we simply buy the homes, that we actually go in as the federal government and buy the homes. At that time, there was a lot of employment in Houston, but people were tied in their homes and they couldn't get out of Flint to go to Houston, which is booming because of the energy crisis. I think there has to be some form of direct intervention in the housing market by the federal government. I think the program...
By the federal government itself or by an agency? Because you were critical of trying to do it in the style of the RTC when we bailed out the savings and loans, and you
thought it should be the
Reconstruction Finance.
Yes, and I think it should be like that. I believe that there should be, and I have believed that, as you know, you're alluding to it for a year, that it was necessary to have a Reconstruction Finance Corporation run independently by somebody like Jesse Jones, who ran it during the 30s. The interesting thing about the Reconstruction Finance Corporation is it put up $3 billion and it got back all the $3 billion. Now, it didn't get interest, it may have lost money, but it got back all of its money. It also started off in banks, but ended up in railroads, and ended up financing a lot of companies during the war effort. So if you view this as sort of a war on credit or something like that, you would say to yourself, well, why don't we think in terms of investment in industry the same way the Reconstruction Finance Corporation did it? And I think that's a much more workable plan.
Let's talk a moment about Alan Greenspan. He testified recently before Congress in which he all but admitted blame for what had happened. He said, and I quote, "Those of us who have looked into the self-interest of lending organizations to protect shareholders' equity, myself included, are in a state of shocked disbelief." Now, are you critical of, wasn't it naive of him to be in shocked disbelief that they would act in their own interests and so subvert the economy?
It's pretty discouraging, isn't it? I used to give speeches on Alan Greenspan's speeches because I found them so interesting. I gave one in Houston about 6 years ago in which I pointed out that in the first part of the speech he talked about the value of derivatives in creating global growth through securitization and other matters. And in the back part, he pointed out that something like 85% of the net worth of each of the three major banks, not by name, but at the time, of course, Citibank, I guess Bank, JP Morgan, I think it may have been Chase and JP Morgan separately, that 85% of their net worth had exposure to derivatives. And I pointed out the inconsistency. I think that inconsistently plagued the former chairman. And I think he was a brilliant political operative in Washington who would provide whatever answer you wanted to find in his statements under the guise of being, again, opaque, so no one could read the true intentions of the Federal Reserve. Now, I think that's a value. I think there's value not to be able to read the true intentions of the Federal Reserve, but on the other hand, I think the speeches came out incredibly ambiguous. And I think he's suffering for that ambiguity today.
Now, as a result of that, we're in this mess. How long do you think it's going to last?
I think it's going to last a very long time. I think it...
How long is a very long time?
Well, I point out that 1973 took 9 years
to
work through. It took 9 years to work through. First oil shock was 73. We finally beat inflation thanks to Paul Volcker to a great extent. And it was not until 81, 82 that we returned to normalcy. I think it could last that long. I don't believe that the stock market will crash, continue to crash. A decline of 50% is enormous, but I listened today to some people on television, and they were talking about the fact that the credit markets and the stock markets still are, the credit markets are still sufficiently tight to make the equity markets not reflect value yet. I think that's possible. I don't know enough about it.
Do you think that lending is going to start again soon?
I do, and if it would start again, the first and
banks have to lend if they want to make money.
The first and most important issue is the short-term market. And I wrote a piece called "It's Credit Stupid" some months ago. You had to solve the short-term credit market. You could not have GE incapable of rolling over their commercial paper. We've mostly solved the short-term credit markets. Now we're moving into the long-term credit markets. The way to solve the long-term credit markets is to take $700 billion, which is the TARP, give it to banks, and tell them they have to invest, they have to lend $6 trillion. If you lend $6 trillion, I guarantee the credit markets will begin to open up.
That is a huge amount of money. Now, just quickly, credit default swaps, not all credit default swaps are bad, are they? They're interest swaps, there's foreign exchange swaps will really cause this problem where credit default swaps linked to mortgages, which were insured by insurance companies that didn't have the same capital requirements and were completely outside their area of core competence. Isn't that the problem?
Well, I think it's probably part of the problems, but you had AIG without knowing the numbers specifically. I think AIG didn't even know the exposure it had to credit default swaps. Goldman Sachs had $20 billion of exposure alone to AIG on forms of swaps. I think the folks just didn't have enough capital. I mean, I had a conversation with Dick Fuld, 6-7 of Lehman Brothers in May, and he was talking about how much capital he needed to get through this. And I believe that Bear Stearns was saved because at that time, Lehman Brothers had 15,000 open contracts with Bear Stearns, and Goldman Sachs had 25,000 open contracts. And I think J.P. Morgan simply took over the book. You had to have somebody take over the book so these things could be worked out over a period of time.
Should the Treasury have moved to save Lehman?
In retrospect, of course. I'm not sure I don't know it's clear in retrospect that was a horrendous mistake. I do not believe that Paulson's remarks, which I saw on Charlie Rose, where he said they didn't have the authority to do anything, that's just idiotic. That's just an abdication of power.
Okay, we have to wrap up, and I have a question for you, Peter Solomon. And the question is, can the net stop the meltdown? And if the net can't, what can?
I have no idea which will stop the meltdown.
I've stumped the star. Peter Solomon, thank you for coming by.
Jimmy, good to see you.
And thank you for coming by. Tune in next week for more on the digital age. For the digital age, I'm Jim Zirin. Good night and all the best.